I'm reading my notes of the most important parts of the 1995 and 96 Berkshire Hathaway meetings. Here are the quotes, the most important quotes that you need to know. Charlie says, "Our managers don't mind being measured, and they know there's a cost to capital. A batting average that does not include a cost of capital is a phony batting average. Managers like to see their batting average posted. There's only two reasons for buying insurance. One, to protect yourself against a loss you are unable or unwilling to bear yourself. Or two, you think the insurance company is actually selling you a policy you think is too cheap." His comments on buying U.S. Air, which he lost a lot of money on. "You don't have to make it back the same way you lost it. The stock doesn't know that you own it. You don't have to do exceptional things to get exceptional results. You can do very ordinary things," said Warren Buffett. Just before that quote, Charlie Munger said, "You don't have to hire out your thinking if you keep it simple." Charlie Munger said, "A problem in many businesses is your employees retire, but they don't tell you." This is about using book value, which is what a lot of people use. He said, "Book value is not a consideration because the best businesses will have less cash and more capital deployed because it gives much better returns. However, with smaller amounts of money, they may use book value more. The most important things to consider are 1, your attitude toward the market, 2, your margin of safety, and 3, look at stocks as businesses, not as paper. These will give you enormous advantages. The first question to ask yourself when looking at an investment: 1, can I understand it? 2, does it earn high returns on capital? And I assume that means ROE or ROIC, a high ROIC or ROE. Charlie says, "We tend to judge by the past record. By and large, if the thing has a lousy past record and a bright future, we're going to miss the opportunity." So he's saying that if it has a bad past record but a great opportunity and a great story, they're going to skip it because they don't want to take the chance until they've seen that it actually works. He doesn't treat banks differently from other businesses. He doesn't look at them differently as any other business. There was a question: should companies reinvest capital rather than pay a dividend to the shareholders? He says no, not if it's already using capital as best as it can. However, any excess cash should be paid back, or it should do share buybacks. Having excess cash or having excess unused capital can tempt management to waste it. Charlie says, envy is the only sin that you don't have any fun at. On share buybacks, he said share buybacks are okay if there's no other use for the money and if it's at intrinsic value or less, meaning if the share price is at its intrinsic value or cheaper, then share buybacks are fine. Okay, for 1996, the notes on the 1996 Berkshire Hathaway meeting, the first important note is there was a question on share buybacks if the share price is above intrinsic value. And he said, if you're repurchasing shares above a rationally calculated intrinsic value, you are harming your shareholders. Just as if you issue shares below that figure, you are harming your shareholders. The tough part, he said, is coming up with that value. So there's a lot more to it than just PE or PB values. PE is price to earnings ratios, and PB is price to book value ratios. He said it's about understanding the business. Later he said it's amazing what you can learn from outside information or annual reports. Read all the competitors' annual reports too, not just the annual reports of the companies you're interested in. Look at it as if you had a business partner and you had been away for a whole year and you wanted him to fill you in on the year and what he had planned for the coming one. The really good business doesn't need great management, but the poor business can only survive with good managers. So it's very important to choose a very good business. The top 500 companies don't all have the best managers the way the Olympics has the best athletes. It's not uniform. They need to be in a good business that treats shareholders right. Diversification is a protection against ignorance, but to have a super wonderful business and put money in something else is madness. 3 wonderful businesses is all you need. A really great business is already protected and less risky than many average, well-known big businesses. Name a business that has been ruined because it was over-downsized. I can't name a single one. But if you asked me to name businesses that were ruined or half ruined by bloat, I could just rattle off name after name after name, said Charlie Munger. Buffett recommends the book The Intelligent Investor, chapters 8 and 20, not necessarily the whole book. A margin of safety should be so obvious you don't need pencil and paper to calculate it, so you don't need a long or difficult formula. You should just be able to look at it and it should jump out at you. When asked what PE ratio, the price-to-earnings ratio, would be so high as to warrant selling, Warren said he would probably just hold it because it has worked so well for him in the past.